Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, on this show, I tend to talk about equity markets a lot. And if you recall last week, equity markets are still in this uptrend and we are at all-time highs on a lot of equity markets globally or near multi-decade highs. And we've seen a little bit of a pullback at the end of January, but the market picked itself up and off it pushed ever higher. Now, this week I want to focus on bond markets because every now and then something happens in markets where you get an accelerated move that beautifully illustrates all the ways that different assets and markets are correlated and react to each other and move. And at the moment, we've got one in progress, and it's related to the bond market. Now, in the last week, and in particular the last few days, we've seen yields on government debt, particularly in the US and in the UK, spike higher. So if you look at the 10-year US Treasury yield, we have seen the yield push above 1.3%, which is the highest level we've seen since the pandemic started. In the UK, the 10-year UK gilt yield, we've seen the yield push above 0.6%. And in fact, it's the speed of the rise that we've seen. It's the fastest rally in yield, so increase in yields that we've seen in 3 months. And that takes us back to the beginning of the vaccine trade when we saw a sell-off in bonds. Now, when yields rise, that means that the value of those bonds, in this case UK gilts and long-term US Treasuries, fall. And if you held a UK gilt fund, for example, you will have seen that it's fallen about 5% in value in the last few days, which is a big move. Now, it also goes to show and remind people that gilts are quite volatile. They're not the safe asset that you would often think. They are quite volatile. But what we've seen is the wobble in bond markets and the bond markets sell off. Now, things don't happen in isolation. What we've seen is some of this bleed over into equity markets in a sign of nervousness in the last few days. And we've seen equity markets start to pull back a little bit. Nothing crazy just yet, just sort of 0.5% a day, nothing too crazy, nothing like a 2 to 3% move in a single day, which often grabs headlines. But we've started to see nervousness around equity markets. Now, to explain why, think of investing like a skyscraper. And I've used this analogy before because it works quite well. So think of the lower risk assets as the foundation. So we can talk about the bonds of this world. And as you move up the different stories of the building, you get the higher risk assets. And at the top, you've got equities. And at the very top, you've got things like emerging market equities. So as the building is structured, the vibrations and movements at the top, they exist. If you ever stood on a tall building, you can almost feel it, that the top of the building will move ever so slightly because of that levering effect. Now, the bottom of the building and the foundations are what keep the building upright. Now, in a portfolio, imagine there's an earthquake and it causes the foundations to wobble. Now, that wobble becomes exaggerated the further you go up, the more that vibration carries on, and eventually you can get the whole thing come down. Now, to use that analogy, what I mean is that when we're starting to get some seismic moves in bond markets, the thing that underpins a lot of risk assets and people's assessment of risk, then you can start to see cracks showing in equity markets, which is what we're starting to see at the moment. And interestingly, what we've also got is the people are starting to look for a haven asset. So we're starting to see people move into the dollar and buy in the dollar. So if we think about what's been happening in equity markets in probably, to be fair, most of the last year, certainly since the summer, I talked a lot about the dollar. If you get the dollar right, you seem to be able to get a lot going right in your portfolio. So a weakening dollar has caused a lot of assets to spike higher and push up, so rally. So commodities, emerging market assets, particularly equities, US equities have started to pick up because the dollar's weakening. As we've seen a movement of people into the dollar, it's strengthened. And of course, that means that all those trends and trades are starting to unravel somewhat. And so we're starting to see a bit of weakness in equity markets. And equally, you start to see the currency exchange rates change. So we saw the pound actually almost get to $1.40 this week, so it's strengthening. But then that started to change in the last few days as the dollar strengthened against pretty much every currency out there, including the pound. So we're getting some interesting moves in markets, and you're seeing how all these different assets are correlated, because as the moves are quite aggressive at the moment in yields, like I say, you're seeing the yield spike on some of these treasuries and UK gilts, developed market bonds that are issued by particular governments. When you see those yields spike, the values fall, and we start to see this spin out into other assets as it becomes more sustained. So we want to see if it does become more sustained, and what it will have the eventual impact on equities. Will they crack and start to crumble? Now, what's causing the rise in yields is the idea of continued government stimulus, or in the case of the US, some big stimulus that Biden is still promising. And he's been on record saying now's the time to go big. And markets are seeing that as a sign that this is going to push and boost US economic growth. If it does, don't forget, as a general pattern, that bonds don't do very well when we've got a very booming economy. And so that is negative for bonds anyway. But of course, the way they're going to fund that government stimulus is to issue more US Treasury. So increased supply means that that supply-demand relationship starts to cause the supply to increase demand, not so much, and therefore the value of the treasury starts to fall. So that's the prices go down, yields go up. So that's what we're seeing. We're seeing a bit of a repricing, and people thinking that inflation is going to come flying back. That inflation or reflation trade has suddenly got another wave of impetus, and of course that's bad for bonds too. Now, it's not universal. You have to realize that bonds are a bit like equities. There are different types and different areas of the market. If you've got some strategic bond funds, for example, you will have noticed that they've probably actually been doing quite well in the last week. They certainly haven't been plummeting in value like a gilt fund, for example. And that's because there'll be other areas of the bond market that will still appear attractive, some corporate bonds, for example. So it isn't a case of just fleeing bonds entirely. But then one of the things you have to realize is that as bond yields start to increase, there is this dynamic that, let's say you are investing and you are investing equities for the yield they produce. As equities are becoming ever more expensive, that yield becomes less attractive comparatively to what we're now starting to see on bonds. So as an investor who is after yield, they will start to look at the two and think, well, the equities are priced quite expensively now, bonds not so much, but I could get an attractive yield, and you start to see some movement across. That is also what's starting to cause this weakness in equity markets. People start to become a little bit nervous whether we're going to see a bit of a rotation going on. It's not often that you see bonds weaken and equities do so at the same time. It does happen, but that's when you get these sort of seismic movements, and it's fascinating to watch. And like I say, you start to learn a lot about how assets behave. We could get to next week and the narrative all changes again. We are still in an uptrend for equity markets at the moment, you have to remember. And also, I mentioned last week that we are in a period that is historically quite weak for equity markets, the second half of February, and particularly so in a year that follows a US election. So at the moment, it's an interesting week. We're starting to see the bond market, the yields rise. And again, another relationship that's being tested is gold. Gold is starting to fall again. It's going down, heading towards that $1750 per ounce level, which if it breaks through, it could mean the price of gold starts to unravel further. And that's because as yields increase in the economy, then the attractiveness of gold starts to diminish. Don't forget, gold is inert. It doesn't actually do anything. And it doesn't produce an income or anything like that. And of course, if the dollar strengthens, then that is also bad news for commodities anyway. So that would mean it would be doubly bad news for gold. So we're starting to see all these relationships, those headlines you see, you can start to see how they are all joined up. So it's fascinating to watch. But as I say, it's very early days in this trend, and it's likely to change in the coming days and narratives flip on their head. So the message this week is bonds aren't boring. They actually could give you a signal to what's going on and an understanding as to what's going on in other parts of the market. So your homework is to keep an eye on the yields of US Treasuries and gilts. And also, interestingly, where we are at the moment with equity markets, it feels very much like equity markets last year, just before the pandemic struck. And to leave you with a thought, this time last year, we were largely dismissing, or markets were largely dismissing, the coronavirus and the potential impact it could have. This year, fast forward, we have a vaccine, but we are largely dismissing the impact these new variants could have. There's a kind of a symmetry there. It doesn't mean markets are going to collapse, but it's interesting when you see parallels, and it's worth going back and listening to some of the videos that I made back then in this series to see what were giving the early signs when we did have a bout of market weakness, and perhaps they could be the same indicators we could see this time around if we are to get a sell-off in equity markets. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, it's money to the masses with the number 2. Instagram, Facebook. Don't forget to join our Facebook group. There's a lot of people in there asking questions and helping each other. It's a great community space. And of course, finally, don't forget to subscribe to our YouTube channel.